banks, in terms of how much they will lend, the capacity is very different between the Halifaxes, the NatWests, Santanders, the HSBCs, etc. Because we've all got different income streams. We get paid in different ways. Some people get paid commission, bonus. Some of us are self-employed. So it's actually like a real minefield to try and do it yourself, which is why something like 8 out of 10 people that purchase a property now are actually going through the mortgage intermediary systems.
Hi there, I'm Matt Stahl, and welcome to the Super Prime Property Show, where we discuss the world of super prime real estate by talking with leading designers, architects, developers, and agents. This podcast aims to explore the intricacies of the industry, delving into conversations that hopefully inspire, inform, and entertain. Before we get started, please could I ask a favor? If you're not already, could you hit the subscribe button and give us a follow? You can find us on Instagram at Super Prime Property Show. Thank you. They say money is a terrible master, but an excellent servant. And this could not be more true in the world of real estate. Mortgages in their various forms are the leverage that makes property ownership possible for many. But you think that these financial products are mainly for those at the lower end of the market who can't afford to buy cash or buy something outright. But this could not be further from the truth. Leverage is defined as using borrowed money to invest. Whether you're a homeowner, an investor, or a developer, this principle is paramount to maximizing profitable real estate ownership. Anderson Harris are a multi-award-winning private client mortgage brokerage, and Adrian, their MD, joins us today to talk all things borrowing money for real estate. Adrian.
Hello.
Welcome to the show.
Thank you for having me on this show. Great to be here.
MD of Anderson Harris.
Yeah.
Could you tell us a bit about Anderson Harris?
Yeah, we're an independent mortgage brokerage. We were established in 2011. There's 8 of us in the business. We work with private clients and we arrange residential mortgages. So we work with all the usual sort of mainstream banks, high street lenders, challenger lenders, etc. We know the private banks as well. So we've got a lot of different clients. They all buy different property types. They live in different areas. They have different income streams, etc. So for us, the key for us is to know exactly which bank to go to when we're writing a mortgage for our clients.
Well, I'm sure you definitely know your stuff. I constantly see you in the press.
Yes.
BBC,
yeah.
Times, etc.
Yeah, I really enjoy doing that, actually. It's a bit more interesting than the usual day job, but it's something we've been doing for quite a long time, actually. And fortunately, I know some of the journalists at the FT, the Times and the Telegraph, and I'm one of the people that they quite often come to if they're looking for new mortgage stories or they need commentary on what's happening in the market. So, yeah, it's a fun part of my job.
I think that, I said in my intro before that, the interlink between financing and property, could not be more interwoven. It is. You can't do property without finance, and it's not. Yeah. And we'll talk about the different profiles of buyers to do that. But it is the cornerstone of real estate ownership.
Yeah, absolutely. And if you look at the country as a whole, like a lot of people will be having to take that mortgage when they're purchasing a property. And property prices and values are so high compared to lots of people's income multiples that most people, when they're getting on the ladder, or people that are moving up, lots of my clients are sort of next-time buyers trying to buy, the last sort of family home. They're having to really stretch themselves, even though they bought a property 10, 15 years ago and they've got lots of equity. So, yeah, a lot of people, when they're moving, they are gearing up and they're having to stretch themselves as much as possible as well.
Yeah. And it's amazing that, it can all work and there are ways that that part of the market can function when you look at the affordability levels versus what the banks will lend you.
Yeah.
What is it? What was the stat? Is it something like it's 11 times
something like that in London? Yeah, in London, I think it's something like that. Yeah. So house prices are way out of context with income multiples. So a lot of people trying to get on the ladder now. Most transactions we write, it's the bank of mum and dad stepping in. Yeah. So the bank of mum and dad are coming along with a, normally quite a substantial gifted deposit. And you've normally got 2 people on the mortgage. So it could be a couple, could be friends, could be siblings, etc. But people trying to purchase on their own now is extremely challenging. So you're normally using 2 incomes and a decent deposit coming in from the parents as well.
So I think most people look at other people and think, how the hell did you manage to buy that?
Yeah.
With your, it's just it's a mystery for many. That's why I think having you on the show today is so interesting, to really understand how people can use different products to get where they need to go. And, it doesn't matter what end of the market you're in, there are options available to you. And it's about using not just, and again, like you mentioned when we spoke the other day, times have changed from when people would just, if you bank with HSBC, you just go to the HSBC broker and they give you an HSBC mortgage.
Yeah.
And that's how it used to be. Right now, it could not be more different.
Yeah, absolutely.
And I think we'll get into that.
Yeah. About 10 years ago, sort of half the people who were purchasing a property would literally go to their own bank or a bank. They would do the research themselves. But if you're going to a bank yourself, you're only ever going to get the product that bank's got. Whereas you come to someone independent like ourselves, we can research the whole market. And it's really interesting to see how much a bank will lend to somebody. We often see scenarios where we've got a lot of clients, live and work in the city, professionals, etc. And the banks, in terms of how much they will lend, the capacity is very different between the Halifaxes, the NatWest, Santanders, the HSBCs, etc. Because we've all got different income streams. We get paid in different ways. Some people get paid commission, bonus. Some of us are self-employed. So it's actually like a real minefield to try and do it yourself, which is why something like 8 out of 10 people that purchase a property now are actually going through the mortgage intermediary system. So
8 out of 10.
8 out of 10,
okay.
Yeah. So the banks are just not as geared up as they used to be to deal with the customers directly. And I think they would rather the applications comes through an intermediary, because we're on the hook for the PI cover. We give the advice. We've done all the assessments in the background, etc. We've certified all the documents. So actually, we're doing all the work. We're submitting it to the bank, but the banks would rather the loans are coming through the intermediary channel, which works well for us and other people in my industry as well.
Yeah, I mean, if you look back in the days, we're looking back, we're talking about 10 years or so ago, that kind of one size fits all model. Where it was back then it was a typical banker client who had this and relied on the bonus, and it was this product, etc. And now, fast forward to today, you've got there's all the sort of challenger mortgage providers, like the way the finance and fintech is changing. And then, of course, you've got the variety of the client spread is so much different. You've got younger clients, entrepreneurial clients, with all kinds of different income streams that you have to explain and untangle, etc. So all very interesting.
Yeah, there's a lot of different products out there, and we all get paid in very different ways. Like I started my career actually working for a bank. So I worked around here about 22 years ago. I worked for HSBC Bank. I was based in Kensington, Knightsbridge, Fulham, etc., which I really enjoyed. That really got me off to a very good grounding. But working for a bank, we only had a couple of products then. We had like a 1% over base, and that was it, and a couple of fixed rates. So it was interesting how even then we were losing out to other banks, and it was around that sort of time where the mortgage market started to get really competitive.
Okay. So how did you go from then to being Spears 500 top recommended advisor 5 years in a row, business leader of the year for a mortgage brokerage? What's that story?
Well, I'm quite ambitious, so keen to work as hard as possible, and I set Anderson Harris up in 2011, really, so I could be in control of myself and my own destiny, and wanted to set up a business where we're in control of like the introducers we work with, the clients we work with, and who I work with in terms of my colleagues as well. So it's been a lot of hard work to get there. It's not easy. But it's most of the time it's been a fun journey.
How important is it to you to be able to control who you work with, especially on the client side?
Yeah, everything. Like reputation is everything, and you want to be working with the right clients. We're very fortunate as a business. Like most of the clients we work with are introduced to us by existing clients that we've transacted with. So the whole purpose of us is to do the best job possible, so our clients can then refer other like-minded clients, etc. But our reputation is key with the banks, with the high street lenders, with the private banks, with the challenger lenders. The banks know who all the intermediaries are. So for us, we're not the biggest mortgage brokerage out there, but we are well known. And I think it's key for us to make sure that we keep the standard of applications that we're we're sending to the banks as high as possible. So that involves us doing a lot of due diligence, with our clients before an application is submitted. We spend a lot of time getting to know our clients, lots of telephone conversations. We need to understand their source of wealth. We need to understand their income, their outgoings, their assets and liabilities. And we need to be able to put together a really good credit application. So when that goes into the banks, that they really listen to us.
And just on that subject of KYC, the know your client, I mean, if you look at the last 10 years, there's been a big shift in political focus on that, especially if you go all the way back to the source of wealth aspects, where the money's been coming from. There was a lot of focus, not just on the mortgage brokers, but also on the estate agents, introducing, they had KYC responsibilities.
A lot more KYC.
It's definitely a cleaner environment that we are in now.
Yeah, it feels that way.
Than we were 10 years ago.
Yeah.
It certainly feels that way, doesn't it?
It definitely feels that way to me. The regulation is extremely strict on the estate agents, on the mortgage intermediaries giving the advice, and on the solicitors as well, the lenders. So, and the banks are really conscious about their own reputational risk. They need to make sure that they're lending to the right people. And the banks do a lot of checks, even back in the day, sort of 10, 15 years ago, when they were maybe lending to more PEPs than maybe they would do now. They still did quite a bit of due diligence, but the landscape feels like it's definitely changed.
And a PEP is a
politically exposed person, in the eyes of the bank.
It sounds exciting, a politically exposed person, but it's
it could do, but it doesn't. It doesn't excite me.
No.
A lot of the clients that we work with, we need to know who they are. Most have sort of got a footprint here, etc. Live and work here, based here. They may have properties overseas, other properties in the country, etc. But I'd much rather sort of try and keep it more straightforward, so we know who we're dealing with, and the banks know who we're dealing with as well.
It has been a great transition. It feels just looking at the whole ecosystem of where the money's coming from and going through, and how that reflects back into property prices, etc. I don't know what it's done for property prices, but it feels like the right it's gone the right way.
Yeah, I think if you look at London, obviously, and prime central London and the super prime properties, that's a totally different market, to the rest of the country. So a lot of people that are buying, the real high value assets in London, and in the country, are probably not necessarily all living and working here. A lot are based overseas, and there's money coming in from overseas. People earn their money in different ways, etc. So the banks are just doing a lot of checks now and due diligence.
Rightly so. Let's talk a bit about the market and what we're seeing today. Obviously, we've had a delightfully long, low interest period, which has come to a shuddering halt recently.
End.
Quite, and things haven't gone as pear-shaped, I think, as a lot of people thought they would go, and I think that is actually a bit of something we could all be almost proud of, in a way, that it hasn't, that the banks have acted responsibly in many ways. Yeah. What are your thoughts on?
Well, we had sort of 14 years of like ultra low, artificially low mortgage rates and interest rates, and a lot of people that had a mortgage then have got used to a certain lifestyle. Their mortgage is normally their biggest outgoing, and maybe it's not, because it's been quite cheap. So the increase in rates, and as quickly as they've gone up, has definitely caught quite a few people out.
You think about this, you say about those people who are making 300-400K and they've got 2 or 3 kids in private school and a couple of leased cars and whatever, and the holidays.
3 holidays a year, etc. So actually that large salary, that large income doesn't actually go as far as it used to now, when you look at the sort of level of mortgage debt they may have, and all the other outgoings, which have also increased as well. But I remember when interest rates were low over the last sort of 10 years, banks, there's a lot of corporate governance in place with the lenders. So in terms of, you mentioned earlier, there might be lending sort of a maximum of 5 times people's income. I remember lots of people who were looking to move or get onto the property ladder, when they knew how much the mortgage payment was going to be, a lot of people were saying, well, why can't the bank lend me some more? My rent is higher than this, or I can afford a lot more than this. But actually, post the financial crash, 2008, 2009, there's a lot of regulation out there with the lenders, and the banks are having to treat customers fairly and be really responsible. And in a way, the lenders have had to protect the consumer against themselves, because I think a lot of people saw that cheap debt and they would have geared up a lot more than maybe they had done had the banks allowed them. But actually, even then, the banks were stress testing the mortgages at, say, 5 or 6%, even though you could have got a rate at, say, 1 or 2%. So the banks at the time did a very good job of making sure that they weren't allowing the consumer to gear up significantly more than they did. And actually, I'm pleased that happened, because otherwise, people would have geared up significantly more at the time. And then maybe we would have seen a lot more people, potentially having to be repossessed or not keeping up with their mortgage payments. Whereas, a lot of people that I speak to have got a lot less disposable income. But if you look at interest rates now compared to where they were in sort of 1989, 1990, there was lots of repossessions then. And although a lot of people are struggling, it's not at all like it was then. And property values have held up, actually, which has been a bit of a surprise, partly maybe because of the lack of stock. It'd be nice if they build a few more homes, but government keep on saying they're going to build more homes, and let's hope whoever comes in next does build some more homes. But that's definitely one of the factors. Plus the bank of mum and dad, I think, sort of passing some wealth down to their children, allowing them to get onto the ladder as well.
And you mentioned, I think when we spoke last as well, that the bank of mum and dad is the 6th or 7th biggest lender.
Yeah, I believe it's the 6th biggest lender.
That.
Yeah. I read somewhere yesterday it's the 6th biggest lender, and I think last time I looked it was like the 8th biggest lender. So
and are they coming
a bit worryingly, they're creeping up.
Is that coming from mum and dad refinancing their equity-rich property from all the years of, or is it?
Yeah, sometimes it can be. I mean, sometimes the parent, they may be taking a loan or something against their property.
Yeah.
Sometimes they may be selling their property asset. They may be downsizing. People's parents may have inherited money from their parents, etc., or just accumulated the wealth. So I think there's a broad spectrum in terms of where that comes from. But there certainly is a lot of money coming down now, down the chain in terms of people being able to get onto the ladder.
It's also that whole thing with the sort of mess we've gotten into with inheritance tax, the level it's at now, people passing it on earlier.
Yeah, I think so. I think so. But I think also, unless if the parent's fortunate enough and the child is fortunate enough for them to help, they may not get on the ladder otherwise. So so it's a big way that people can continue to purchase.
And going back onto the rates where they are now, and it's debatable whether we can talk about that in a bit, whether we think they're going to start coming down or not. But what about cash transactions? Are you seeing more of them?
There's definitely a lot more cash transactions in the marketplace than there were. Yeah.
Do you find people? Do you see people coming to you saying, "I want to refinance or purchase this asset," and then getting a little bit of a reality check about where we are on rates today, and then deciding actually no, I'm going to buy it outright.
Yeah,
or paying down debt accordingly. Or
we've definitely seen some of that. So a lot of my clients will have sort of fairly high value properties, fairly chunky mortgages, decent income streams, and maybe other assets as well. And what I've seen over the last sort of 18 months is when clients have come to refinance, their 2-year fixed or 5-year fixed rate is finished. They're coming off 1 or 2%, moving on to 4 or 5%, and if they've got other assets, they kind of need to be getting about 9% back on the other side of their balance sheet for them to justify to keep the mortgage. So we've definitely seen quite a lot of our clients who've got the ability to start to repay their mortgages. And in fact, if you look at some of the news in the industry, a lot of the mainstream banks have also had record amounts of mortgages actually being repaid, because some people do have some other assets. And I think when the mortgage has been really cheap, people have just kept that mortgage running, etc., because it hasn't really cost them very much. But if they've got the ability to pay part of it down, then I think they have done as well. Another thing I've seen as well is a lot of the clients who are looking to trade up to buy a bigger sort of family home. Lots of those clients are they have been used to paying a cheap mortgage, and I can normally get them to the mortgage amount that they're seeking. But when they see how much that mortgage is actually going to cost on a monthly basis, they're quite often saying, well, actually, I think I'll stay put. So we're definitely seeing quite a lot of let's wait and see what happens. Yeah. Mortgage affordability is a bit of an issue, because when the interest rates are higher, the banks are stress testing the affordability at a high rate as well. So if your income and outgoings haven't changed, most people can't borrow the same now as what they could maybe 2 or 3 years ago. So banks are stress testing mortgages at a higher sort of level as well. So a lot of people are waiting for interest rates to come down and mortgage fixed rate pricing to come down a bit. So it helps with their affordability, also helps with their mortgage capacity as well. But it feels like there's so much pent up demand. I do wonder if rates start to come down, our property value is going to start to go up again, because there's definitely a correlation between property values and interest rates and mortgage affordability as well.
It's a confidence play, isn't it? I think suddenly when you've seen the way inflation's gone and interest rates have gone, it's almost like the second the first drop happens, the first point starts going, and the first 25.25% goes down. It's almost like, you've gone over the top of the hill now and you're about to, the mentality, so you're going to freewheel down and hopefully it's going to, you're going to get back down to that level. Might not be the case, and as you say, values might rise at the same time. To compensate for that, but
if people are needing to gear up, they don't want the mortgage to cost any more than it's going to have to cost them as well. So I think, if rates come down, or when rates come down, and we do think they're going to come down fairly soon, that is going to help with people's mortgage affordability, and hopefully will give people more confidence. Buying a property, they're expensive, and nobody, everybody's going to be sort of as cautious as they can around their mortgage.
Yeah, it was interesting. We talked about earlier where you said that, where the banks have built in these stress tests essentially, which have saved us from ourselves, getting ourselves into trouble. And it's not often we talk about the banks in this way. Who was it, or who was it who put that into place?
It was the Financial Conduct Authority.
It was the FCA.
Yeah, it was the FCA.
Post 2008.
Post 2008, post 2009. So a lot of mortgage regulation came in around 2014. Where anybody taking a mortgage has to get advice either from their own bank or from a mortgage intermediary, and there's just been a lot more stress testing, banks being a lot more cautious around people's affordability, ongoing affordability, etc. So I think everybody moaned about that at the time.
I remember.
Everybody moans about it, but actually the reality is, when you do have a scenario like we have now, that we weren't necessarily maybe expecting, the reality is maybe not going to be as bad for as many people. Yeah.
It's funny, because you remember when COVID started, do you remember there was that period where the bank said, you can, offset a few months mortgage payments to help, with the uncertainty at the start of COVID when the first lockdown was coming.
That's right. Mortgage holiday.
The mortgage holiday.
And
when that was happening, I remember just thinking, we are on the cliff edge right now. If they were talking about having a 2-month holiday, that would save people. Forget about interest rates going up. How bad is this going to be? And it actually was the complete opposite. The market had this quiet period, and then it just shot off like a rocket. During COVID.
I mean, that was an incredibly anxious time, I think, for anybody who's got a mortgage. Certainly an anxious time for me, with my clients, because a lot of my clients, they're professionals working in a city, and a lot of the mortgage applications we do is bonus driven. So when COVID happened and everybody locked down and was at home, I was just thinking, well, are any of my clients ever going to get paid a bonus again? Is anybody going to be able to move on,
and they're relying on those bonuses.
Yeah, they're relying on those bonuses, to sort of justify the next mortgage. And so it's definitely quite an anxious time. But to help get the property market moving, we had the stamp duty holiday window. So that encouraged a lot of people to purchase, and interest rates came down. And we saw sort of the cheapest fixed rate pricing, I've certainly ever seen, and I think there's probably been out there, around the summer of sort of 2021, et cetera. It's ridiculously cheap. And lots of people were looking to purchase. We had lots of clients move out of London, buy properties in the country, et cetera. It was a very busy time, and I definitely wasn't anticipating that when we all locked down.
I think it was like the start of lockdown. I was walking down the King's Road. It was like mid-morning, and I saw my chiropractor was walking up towards me, and he had his earpods on. And he'd been on the phone to Barclays on hold for the last 3 hours, frantically trying to get hold of them so he could book this mortgage holiday. I remember just thinking,
it was,
my word,
It was definitely quite distressing. As a company, actually, we reached out to lots of our clients at that time because banks weren't really accepting new applications. Estate agents weren't able to work. You couldn't view a property. Surveyors weren't able to actually go and survey a property. So actually, we reached out to lots of our clients. We picked the phone up and spoke to a lot just to make sure they're okay. Is there anything we can do to help, etc. Because there was the stamp duty holiday option out there. Although I'm still a bit skeptical in terms of what that might do to people's credit profile. And I think a lot of our clients, if they were able to to continue to pay their mortgage, they were continuing to pay the mortgage.
So you think that the stamp duty holiday would affect the credit rating? How do you mean by that?
No, not the stamp duty holiday window.
No, the mortgage.
The mortgage.
You think that could have an effect on credit?
It's difficult to know. I mean, the algorithms you've got with Experian, Equifax, etc. Sort of everybody 7-year history, etc. People having to make payments. I don't know.
Sure.
I mean, I don't really know for sure. But I just think if you had the ability to pay the mortgage, and you're still getting paid, and your outgoings have probably gone down, then why not continue to pay the mortgage and maybe put yourself at risk?
Very true. Very true. I mean, because you don't really hear much about repossessions, do you?
No.
It's nothing like it was back in 2008, 2009. You know, it's...
Yeah. The banks really have to try and treat customers as fairly as possible. They're all trying to be responsible, and the mortgage regulation, is very tight. So, and the banks' reputational risk. The banks are
don't want to be seen as...
Don't want to be seen to be kicking families and people out of their own home. And that's why we've got so much regulation around the mortgages. It's it's serious stuff. We're arranging mortgages against people's assets, their home. It's probably their biggest outgoing. It's quite a big deal for the client to take a mortgage. So for us, there's lots of hand holding. Got to make sure that actually that is the right thing for them as well.
Sure. So 8.5 out of 10 people pretty much use a broker nowadays, or an intermediary to facilitate their purchase. Whereas back in the day, you said it was about 50% direct to bank.
Yeah.
And for the client who's going via a mortgage intermediary, in a way, they've already got the door half open to the bank if they're going with somebody who has got a reputation for doing proper DD, proper KYC, etc. The banks are way more open to looking at a mortgage for them, especially if they're looking for something a little bit out there, but they haven't got a standard income. They've got, they've got retained earnings. They've got, there's so many, in today's world, especially those at the upper end of the market, they do not just fit into the,
I mean, clients and buyers at the top end of the market, they may not have an income stream. They may not have an income like most people would have if you're getting a mortgage. And in fact, the banks and the regulator really like people to have an income. It's people's income that's really driving their mortgage capacity. So when we're looking at sort of wealthy individuals buying, higher value properties, they're not necessarily going to have that income that's going to be ticking the box.
They're not going to have 6 months pay slips necessarily.
No, not necessarily. They may be self-employed. They may be limited company owners. They may have retained earnings in the business. They will most likely be paying themselves what they need to be paying themselves, but actually there may be lots of retained earnings in the business. So we know which banks will look at that type of profile of buyer. A lot of other buyers may have heavily bonus, so they may have a lot of bonus, may have lots of commission, etc. Banks love stability, they love certainty. So banks love it if you've got like a nice basic income, but if you've got variable income on top of that, some banks look at it quite differently to others. So I guess one of the main advantages of coming through a mortgage intermediary is this is all we do. We sit at a desk all day, we write mortgages, and we write the protection policies that go alongside the mortgage. So we're experts at this, and we know which bank will enter which client against which type of property. So the advantage of somebody looking to purchase a property or looking to remortgage, the advantage of coming to an intermediary is we will know immediately when we speak to them which banks won't consider it and which banks will consider it. So we can save them hopefully a lot of money in terms of the interest rate to make sure we get them the very best terms out there. We can hopefully get them the loan that they're seeking, because banks have different amounts there as well. And the hassle factor of arranging a mortgage, there's a lot of documents needed, pay slips, bank statements, and we take a lot of the legwork out for our clients. Most of our clients are pretty time poor, and we try and make the process as simple and straightforward as possible for them. And we talk to everybody else in the process as well to make sure that everybody else is on track.
It's truly a personalised service.
It is, yeah, it is. Yeah, you have to be really.
And with the banks, in my experience, having dealt with mortgages being self-employed versus being employed, it's crazy to me how different the banks view the two side by side. You can I'm just interested to hear about you saying how they'll consider the bonuses, because I would think that anything variable, they'd be negative towards. I mean, if you're employed, they just want a few months or 6 months, 3 or 6 months bank slip, pay slips, etc.
Yeah.
But if you're self-employed, it's years of accounts. They'll bring in all the deductions, they'll bring in all the your expenses, etc.
Yeah.
Whereas if you're salaried, they don't have that.
Yeah, it may not always be years of accounts, but a lot of banks do want a good track record and a good track history there. So the thing that the lenders like, they like certainty. They like to see income coming through. So if you've got a base salary, that's great. You mentioned a variable income like bonus, etc. If you've consistently been receiving that income over like a 2 or 3 year period, then the banks will normally presume that will continue.
Will they take a percentage?
They will take
a
percentage, yeah. So they normally take, like for example, half. They may take half of the bonus, etc., half of the average of the last 2 years, etc., as long as the most recent year was higher than the one before. There's always caveats that the bank will do to protect themselves. But yes, they will consider variable income. And to your point around being self-employed, lots of people, when they're self-employed, you'll have a certain amount of turnover into the business, and there'll be a certain amount of costs in that business as well. And then the net profit at the end before tax, may not be as high as you thought it might be.
Mm-hmm.
You might have a really good accountant.
Tell me about it.
Yeah, you might have a really good accountant. And that's kind of the accountant's job, I guess, is within all the rules that you can do, is to try and sort of make them look as attractive as possible for their clients. But it doesn't always help when it comes to the mortgage, because the banks, they love to see tax returns, self-assessment documents, etc. But there are lenders out there who will take more of a holistic view. They will take more of a view on the limited company, the profits, and some of them will take a view that there's a good profit there year on year, but if it hasn't been taken out, you could have taken it out, and therefore they may lend you significantly more than another bank.
And that's where a good mortgage intermediary will really make all the difference.
Definitely.
To find that.
Yeah, definitely. Because the consumer is not going to know, out of the sort of hundreds of banks, they're not going to know which bank is going to look at that most favourably.
And there are hundreds.
There's hundreds and hundreds of mortgage products.
Yeah.
There's probably nearly sort of 100 lenders out there who will lend. So yeah, it's good. There's a lot of competition amongst the banks. The banks, even though the mortgage rates are quite high, the banks do have a strong appetite to lend. They do want to get the money out the door. The difficulty that we're seeing is the reason why there's less mortgage lending taking place is partly because the consumers are pulling back a bit because it's quite expensive and the rates are high, or maybe they're not able to get the mortgage. But banks make a good profit from the mortgage. It's secured against a property. It's quite secure lending. So the banks are trying to get
They want to
lend. Yeah, they want to lend, which is why they've all got sort of different sort of policies around, okay, we'll enter this client or that client. So there's lots of sort of nuances there. And
what about refinancing? Because if you look in the construction sector, typically the refinancing was a big driver of construction projects, extensions, basements, whatever. And when the interest rate shot up, we naturally expected that would slow down, because people are thinking, that side extension that I want to pull out 100K for is suddenly they get the refinance quote, and it's like, forget it. It's not. I'm not doing that now. And, has that been?
Yes, it's definitely an issue. So it's almost a double blow, because the cost of doing the works to your property is significantly increased. The labour costs, the materials, etc. So that's increased, but also the cost of getting the debt to pay for that has increased significantly as well. So we've over the last sort of 5-10 years, we've had numerous clients sort of come back to say, we're going to do the side return, etc. Big open plan kitchen. The mortgage debt's been quite cheap to obtain, and building costs were lower then. So definitely now it's a lot more expensive, and clients might be halfway through their fixed rate, and the fixed rate is quite competitive. They're not paying that much on the main bulk of their mortgage. They want to do an extension. Well, the new rates you're going to get on the new debt is going to be the rates available today, not the rate you got 3 years ago. So it is costing people a lot more money. So when they see how much that extra bit of mortgage debt is going to cost, and then when they get the quote through from the builders,
reconsider that kitchen.
I think people maybe don't need that kitchen anymore.
And what about going to the other end of the spectrum, the ultra high net worths? How about, that's a slightly different beauty parade, shall we say?
Yeah.
That's away from the high street guys typically, isn't it? And more towards the private banks
that
you'll
go
to?
Yeah, absolutely. So like the real high net worth clients who maybe don't fit the criteria of a mainstream high street bank, etc. The private banks are the obvious banks that we can go to for them. The private banks, they're not typically known as being mortgage lenders, but they do like to lend to wealthy individuals. Normally in the hope that wealthy individual can go on and do some other type of banking with them. If you get your mortgage with a mainstream bank, well, you've just got your mortgage and nothing else. But if you're going to a private bank, the private bank will take a long time getting to know that client before they issue a mortgage offer letter. The credit piece will probably be quite complex as well. But yes, that bank will be able to go on and do maybe FX with them or other investments as well. So
asset finance.
The private banks are very keen to lend to wealthy individuals. They've got strong balance sheets as well and keen to lend.
But they're also bound by the same FCA.
They're bound by FCA affordability testing.
They are as well.
Yeah, they are, but they can work slightly differently. So if you've got a high net worth client who has a significant amount of assets or a significant amount of income, they can underwrite the application slightly differently, but the bank will still have to be able to demonstrate affordability. They have to demonstrate that person taking that mortgage can afford to be servicing that mortgage on a monthly or quarterly basis, and that they've got some sort of suitable repayment strategy in place. So the private banks will lend. They will be a bit more holistic. They will look at the big picture, whereas maybe the high street banks won't look at the big picture. But it still has to fit affordability and the plausibility tests.
Can they get around that by not calling it a mortgage? Can they say, well, that's a lovely boat you've got. I'll lend you, £5 million against that boat, and you can use that for whatever you want, like buy a house?
They might be able to. I mean, I don't see that side of things. But the thing is, with wealthy clients, they may have a boat. They may have a line of investments with the bank as well. So actually, the mortgage piece may just be a small part of what they're doing, like the mortgage secured against the property. But yeah, if the debt is secured against the property, it's going to be a regulated mortgage.
If the debt is secured against it, if there's a charge on the property, then it classifies.
If the applicant's living in the property, so if the person's living in the property, then it's a regulated mortgage, and the banks have to make sure that they're doing all the due diligence there as well. A bank might be lending to a client for investment purposes, so it might be a buy-to-let. So the regulation is slightly different, but the banks still have a duty to their shareholders, to the customer, etc., in terms of making sure that it's affordable as well.
Okay. I've heard about private banks, their responsibilities in that line, doing wealth checks and using private investigators to get to the bottom of people's source of wealth. And how far do they go?
Well, if a private bank is lending to an individual who may have a global footprint, etc., then they will go to. They've got well-checked systems. They've got different systems that sort of the high street banks would have as well. They need to make sure that they know who they're actually lending to as well.
It's no joke. They really need to make sure they know. Yeah,
they need to know exactly who they're lending to. Yeah, and I think sort of back in the day, I didn't really see much of it, but I know sort of back in the day when they were lending to more clients from certain jurisdictions that were higher risk, I think the banks were sort of having quite substantial sort of checks done in terms of proper reports from companies.
There's been a lot of penalties.
Quite a cost to the bank.
There's been a lot of penalties for banks.
Yeah. Some of the banks have had to pay a penalty. Yeah, for maybe not doing what they should have been doing.
Okay, not the first time. And you're as a brokerage and as an intermediary, your relationship with the underwriters, how important is that to the client?
Yeah, very important. Yeah, it's very important because the client needs to know that we've got the ability to be able to transact their mortgage. And there's thousands of mortgage brokers. So we need to make sure that our relationship with the underwriter is rock solid, that they know that we know our clients.
And the relationship is everything because there isn't, in terms of the regulation piece, but there's not particular qualifications, there's not any kind of tiered rating or that you get as a brokerage. Really, it is reputation, isn't it?
Yeah,
there's nothing else really.
We're all regulated, so we are regulated. But actually, in terms of the intermediaries' relationship with the banks the reputation is very, very important. And I know when we're putting high value mortgages through the private banks, or even the mainstream banks, we know the underwriters really well there. I spend a lot of time actually putting together like a credit report for them, a credit paper. So there's details around the applicants, how they made their money, details around the income outgoings, assets, liabilities, and then I have a bit at the bottom around the documents that I've got to evidence everything. So I'm kind of doing the underwriter's job for them.
I see.
I'm probably going a bit too far.
I bet they love that.
Yeah, they do. Yeah. And I kind of do this because I want to make sure that the underwriters know that I know my clients. And if I send all this additional information through, they know I've really thought about this transaction and I really do know the client, and they will look at the application properly as well.
And you take a risk from that aspect in the sense that it's your PI cover, essentially, that's covering that.
We're on the hook for the advice that we give. Yeah. So every mortgage transaction we write, we're advising and recommending that they take that mortgage. So we've got to make sure that that mortgage is affordable, that the mortgage is suitable for what they're looking for, that the rates they're taking is the right rate based on their circumstances. You know, if they think they're going to be paying the mortgage off in a couple of years, or they're going to be moving and maybe not buying another property, well, we shouldn't be writing a 5-year fixed. Even if that client wants a certainty of knowing what their payments are going to be over a long period of time, we've got to make sure that we're recommending the right product for that client based on their requirements.
Okay. And year on year, it is actually believable. It always seems like things are getting more and more complex and harder to do it. But year on year, the banks are getting better at writing high value mortgages.
They are.
Yes.
It's
we contrary to what people think.
We think they are. Like a lot of the mainstream high street banks have really upped their game, and they're good at lending interest only mortgages, which a lot of the wealthy borrowers like to borrow interest only. They're much better at looking at variable income, bonuses, etc. They've got good teams of underwriters at these banks who understand the sort of the high value cases.
Not just box ticking.
Not just box ticking. There's an element of box ticking, and sometimes we're not always able to sort of shoehorn that sort of wealthy client into a mainstream high street lender who's got market leading rates and very cheap arrangement fees. But they're over the last sort of 2 or 3 years, we've noticed that a lot of the mainstream high street banks have got high value underwriting teams, and then we get to know their underwriters because that's the space that we're in, and then they get to know us, which helps.
PEPs aside, is there like a client profile that you struggle to arrange financing for? For example, Bitcoin, a Bitcoin millionaire. Let's say they only got values and assets in Bitcoin. Are banks, how flexible are today's banks is what I'm trying to get at.
They really struggle with that. They really struggle.
So crypto is the worst.
Is very difficult. And in fact, if you're trying to purchase a property and your deposit is in crypto, that's going to be quite difficult as well, because you're not really going to be able to evidence the deposits in the format that the bank like to see, with your name, address, the date, etc. on a kind of a photo of the crypto wallet saying, "Look, here's my deposit to buy the property." Doesn't go down.
I've forgotten the password though, so I can't access it. But
but it's kind of here anyway, and hopefully it's going to arrive when I complete on the property.
Yeah.
I think the one of the challenges that quite a lot of the banks have are sort of clients who don't have income, but they do have wealth. They may have like a significant amount of assets or investment portfolios, etc. Maybe looking for a modest, limited amount of mortgage lending. But if they don't have the tax documents to show they've got a regular income or don't have that employed income, it gets a bit more challenging, because the banks, it's not asset-based lending. The banks are looking for that mortgage to be serviced and ultimately be repaid as well.
I mean, even I can't remember how many years, probably 10 years ago. I always think like it's a few years ago, but normally it's actually way longer.
Yeah.
Even like, I remember one time I was trying to get a mortgage for something, and I was showing the broker at the time my Hargreaves Lansdowne account, and I was saying, look, I've got, this is in this fund, this is in this fund, this is in this fund. And they wouldn't touch it because it wasn't liquid, they said.
Yeah.
And I said, I can sell these and have the money in my account in 3 days.
Yeah.
They were like, no. So I had to sell them and show it in cash in my account before
Yeah, that's interesting.
And it's a long time ago, but it's like
but in terms of how the banks view mortgages, they like to see income and keep it simple. And we've had clients who have got that, they're looking to borrow a lot less than what they've got in investments. The investment portfolio might be twice the amount of what the mortgage is that they're seeking to borrow. But unless the bank take a proper view on that income that they may be able to get from the investments, they may struggle to underwrite that application. But somebody coming along with 3 months pay slips, which ticks boxes, is much more straightforward for the banks. And that's kind of how the FCA have wanted the banks to be viewing lending. So this is why people come to companies like ours, because we're independent.
Sure.
And we can look at the fact they've got other assets, but we know which banks will view an income from there and which banks won't view some sort of income from that, or affordability.
I always wondered with the banks, if you're going back to the sort of employed versus self-employed status, if you come from a self-employed status and they want to see 1 or 2 years accounts, and let's say you've got a strong balance sheet and you're solvent and there's a proven track record of profitability, etc., there still is extreme, there's a lot they do a lot of checks into it, and they're still not that comfortable with it. But you can come to them with 3 months or 6 months pay slips from Joe Boggs Building Limited, and they do 0 checks into Joe Boggs,
Well, they will always do background checks into like who you're working for, etc.
They will,
but
just standard credit checks.
Yeah, but I think to your point, you could get a brand new job somewhere, and you could present 3 months pay slips because you're 3 months in, or you may be a month in. You've got an employment contract. The banks quite like that employment contract and that pay slip because that's showing they think that's going to be sustainability of income. But back to your point, you may be self-employed and a good track record, history, etc. But your income may be lumpy. When you're self-employed, your income may change, etc. And if your most recent year is not as strong as the year before, then they may not be looking at an average, and then they may be asking, okay, so you're self-employed. We need to see the last 6 months bank statements to show that you're actually on track to hit the turnover that we think you're going to need to get the profit that we're looking for. Whereas if you've got the 3 months bank statements, well, that's a tick in the box as long as it fits the multiples, and then as long as their outgoings fit the multiples as well, that could be more straightforward for the banks.
But it must really be only going one way. That there must be more and more products that are closing this gap, bridging between these two sectors to make it easier for self-employed, because it's the market's only going that way, isn't it?
Correct.
There's so many.
Yeah. We don't all get paid in the same way that we used to get paid. People sort of have different jobs, different income streams,
multiple
income streams, etc. Banks will look at multiple income streams. But again, they want to see consistency. They want to see it's realistic that's going to continue as well. But they can look at multiple income streams. But the banks, they're often a little bit behind the curve. They're big machines, and it does take them a while sometimes to get up to speed. But I know they're all trying to be as innovative as they can to start to underwrite their applications better.
And a lot of your clients will come to you and they'll think that their personal situation is actually more complicated than it is.
Yes,
they'll come. Yes. I've got this crazy. But actually, this is something you see day in, day out, and have a solution for it.
Yes. It happens the other way around as well, by the way, where some new clients will come to us and think their circumstances are quite straightforward.
I've got this fantastic OnlyFans account, which is
but there may be something that stops it. But it does happen the other way, where some clients think that it's going to be quite straightforward, and it's maybe not so straightforward. We've got to work really hard. We can't necessarily always go to the cheapest bank. But yes, we've had other clients that we've met where they think their circumstances are going to be quite complicated. They may be, for example, an equity partner in a big law firm, and they've just gone from being a partner to an equity partner, self-employed, etc. They may only have 1 year's tax documents. And in fact, when you work for a large sort of law firm or accountancy practice, you're self-employed equity partner, the company year is different from the tax year as well. So actually, the tax documents that they can show are almost sort of 2 years behind the real income that they've actually seen, like the partnership profits and drawings that they've had. So in reality, it's not that complicated. Like, we know which banks will look at that. But if they sort of just Googled the first bank and tried submitting an application, it may not work. So yeah, we definitely see some clients where they don't necessarily need to be going to a more expensive bank.
Okay. All right. Interesting. And what about good old buy-to-let? What is happening to buy-to-let?
Yeah.
I mean, it is
it's challenging now. It really has been challenging. We've for a number of reasons. I mean, firstly, if you've got a mortgage, your mortgage has increased significantly. So your outgoings, the cost of that buy-to-let property is going to be more. The message that we've sort of had from the government really is don't invest in buy-to-let. Don't invest in second homes, So if you want to buy a buy-to-let, you're going to be paying additional 3% stamp duty. Those people have a mortgage if you're a high rate taxpayer. You can't offset the same sort of way that you used to in the past. So actually, there's a lot of factors that have made that buy-to-let mortgage property not nearly as attractive as it was. And I'm sure there'll be quite a few individuals out there who have got a buy-to-let that's fairly highly geared with a mortgage. They've gone onto a very expensive mortgage rate, and the mortgage rate might be quite similar to what the rental income is going to be. But when you get to the 31st of January and you've got to pay your tax bill and you can't go offsetting as much as you want to, well, that buy-to-let investment might be costing you money. So the landscape has changed significantly. And in terms of obtaining a mortgage for buy-to-let property, the banks are stress testing that buy-to-let affordability in a much higher way than they were, because their monthly payments are significantly higher. They're going to stress test it higher. So actually, a lot of people cannot borrow the same amount on a buy-to-let mortgage now than they could 2 or 3 years ago. So we sort of picked up on mortgage prisoners, for example. Like, a lot of people that have a buy-to-let mortgage or historic buy-to-let mortgage, they may not be able to remortgage to another bank. So if their rate is coming to an end, they're most likely going to be having to take whatever rate that bank's got at that point in time.
Why? Why is it that another bank won't take them? Because they won't pass the credibility.
They probably won't, or they may not pass the affordability checks. Yeah. So you need a certain amount of rental income to cover the mortgage, and the banks are stressing the mortgages at a much higher rate than they used to. So where that buy-to-let mortgage would have fit the stress testing 3 years ago, it may not fit the stress testing now. So even though you've been keeping up your payments on that mortgage, another bank might say, well, we would have done that debt 3 years ago, but we're not actually going to do it now. So you may have to keep that mortgage with the same lender.
So if you're one of those mortgage prisoners, you're never in. Are you ever at risk of the bank calling in the debt?
As long as you're not in breach of your mortgage. So as long as the monthly payments you're making every month are going to the bank, and you're not in breach of the terms and conditions of the mortgage, then in theory, the bank have no reason why they're going to come back to you and repossess the property.
But if for example, they bought something for $1 million and they borrowed 750 grand on a 75% buy-to-let, the terms say that it's a 75% buy-to-let. So if the value's fallen to 900,000,
yeah,
does that ever happen in these kind of mortgages? That
it could be an issue when you come to refinance. Yeah. So it could be an issue when your rate comes up at the end, if you've got a certain loan to valuation and your property doesn't fit that same loan to valuation criteria, then you may have to pay a higher mortgage rate. So the rates that the banks offer are based on the risk, essentially, in the loan to valuation. So if you've got a 25% deposit, the rate that you're going to be paying will be less than somebody who's got a 10% deposit. If, for example, you're buying a main residence. So yeah, if you come to refinancing your property, then yes, you may have to pay a higher interest rate on that mortgage.
So even with these products, they're not at risk. As long as they're paying the repayments, they're not at risk of the bank calling in the debt.
As long as the consumers were paying their mortgage on a monthly basis, I haven't sort of seen any scenarios where the banks are calling the mortgage in, because they haven't really got any right to, because the debt's there. It was given at that point in time when everything fitted criteria. Yeah. The consumer's still paying the mortgage. Some buy-to-let lenders will consider sort of topping up the rental calculation if you have a good, strong personal income in your own right. Then some of the lenders will consider topping up the perceived shortfall in the rental calculations with an income top slice. So there's some buy-to-let lenders who may lend significantly more to people who on paper have a higher income in the background and could use that money to service the mortgage if they want to. Because the criteria for buy-to-let mortgage lending has been quite simple and straightforward in the past. Most people need to have you normally need to have your own main residence to get a buy-to-let, and you normally need an income of about 25,000. So the criteria has been quite straightforward.
Okay.
And something we've often seen, which we don't see now, is consumers who have inherited some money or got a big bonus, etc. Like the dinner party buy-to-let buyers, where they got a couple £100,000, and when interest rates were much lower and the tax was different on the buy-to-lets, property values were going up. It was quite attractive to buy a buy-to-let. You can see that property, you can physically see that investment, but we don't see many people, or nearly as many people, taking buy-to-lets now. It's definitely there for people that are not necessarily sort of accidental landlords. Most people taking a buy-to-let have really thought about it.
What was George Osborne thinking when he brought all this legislation in? I mean, I know he wants to, obviously they want to sort of curtail second home ownership, but it's rather un-Tory for them to do that. And I mean, how effective has it been? We obviously need a private rented sector in the UK. It's very much in Europe. It's standard place to rent. I know it's in the UK every home's a castle and all that, but it's just, to me, seems like one of the most bizarre policies to come out of that Tory government.
Yeah, I think it comes down to your home is your castle, etc. And I think what the Tories wanted, they wanted people to have their own home ownership.
So they vote Tory.
Yeah. So they vote Tory. So people can have their own property. And the message was quite clear coming up from George Osborne. It's almost like, don't invest in a buy-to-let. Don't invest in a second home, or if you do, you're going to pay a high amount of stamp duty. We're not going to make it as attractive for you, etc. Because we want to see people having their own home ownership. The Tories haven't really been that conservative, have they? When it comes to property, and I think people who invest in property haven't necessarily felt that the Conservatives have been on the side that they would hope that they would have been.
And also, if you look back at it as well, the buy-to-let market was just on fire.
Yeah.
It was absolutely on fire. And then, of course, you had the big issue with, all the properties being sold off plan and sold abroad. And it did need fixing. I just don't think that was the right way of doing it.
Yeah, I remember friends of mine, looking to get on the ladder years ago. You're trying to get on the ladder, you're putting an offer in, well, all of a sudden somebody else has come along, buy-to-let landlords, and they've offered a bit more and they can transact quickly. So it's disappointing for people.
It is disappointing. What do you think? By the time this episode goes live, we may have a new government. So oddly enough, I don't know what Labour's policies are on the subject. I know what reforms are. They've been quite vocal about that. They're very pro-property. They're not talking about the rest of their policies, but oddly, it's very, very hard to get clarity on what Labour's stance on this will be.
Yeah, it's not clear. It's not that clear at all, really. But I think a lot of people who maybe invest in property have probably felt quite let down by the Conservative government anyway. So I don't know whether there's going to be a big difference in terms of property, how we get taxed, etc. I'm not too sure whether there's going to be a big difference. The Tories are definitely sort of putting something out there to say, can you trust a Labour government with your finances, etc. But a lot of people, I think, are quite concerned about capital gains tax
on primary homes.
Yeah, not on primary homes, not necessarily on primary homes, but capital gains tax disposal on investment properties, etc. And in fact, sorry, just coming back to that, actually, some people might be concerned actually about capital gains tax on their principal residence.
I think they should be.
Well, yes, exactly. Yeah. But in fact, I remember, and you'll probably remember quite well, in December 2019, when we had the general election, it was Boris against Corbyn. And I remember lots of people
panicking.
Yeah,
mansion
panicking.
tax as well. Mansion from Ed Miliband before that as well.
Absolutely. The mansion tax. So lots of people were panicking. So I don't see the same level of panic now, but there's definitely a level of concern, level of uncertainty as well.
Yeah, I think the level of panic isn't there because, things like mansion tax there were many people who just could not have paid that.
Yeah.
That would just be the most unjust, in my opinion, tax ever. But
lots of little old ladies who
got a
bought
£2 million
a house
in Highgate.
in Mayfair, and now they can't afford that every year.
But I think people are thinking, well, if they apply CGT to my it's less profit. It's I just won't sell, etc., etc. So it's like there's also the reality that suggests that CGT could go up to income tax levels.
Mm.
I mean, that's also a real fear on that front. But
it's we've got to be paying for the NHS, and somehow we've got to be paying for what we're going to be providing people. So I think whoever comes in is most likely going to be having to tinker around with the tax.
Yeah,
and that's
a lot of tough decisions to be made.
Yeah, definitely, and that has an impact on people at the moment looking to purchase a property.
Yeah,
because people like certainty, people like to know what's going to happen, and when there's uncertainty, people are less committed to buying a property, especially if they're a bit more discretionary. If they don't have to purchase right now, a lot of people will just take the view that, well, actually, we will just wait. We see what happens. We see who's in power. We pretty much know who's going to be in power, but what are they going to say?
Yeah, the Blair years were fantastic.
Yes,
from the property sector.
Yeah. I remember. I remember Gordon Brown saying no more boom and bust.
Yeah.
And then what happened? But they were great years. But globally, they were great years globally as well.
That's
I remember.
True. Yeah.
And we were both around at that time, sort of enjoying the property sector. But the banks were behaving very, very differently to how they are now in terms of the lending, and property values were increasing very quickly. And, there was a real good mood out there, wasn't there, until we had the financial crash. But there's a lot of good years for people then.
Yeah. I think there's, I do have a lot of confidence personally in Rachel Reeves. I think she'll be good.
I think so.
Famous lobster.
I don't know, to be honest. It's very difficult to know what might happen or what sort of policies are going to come into place. Nobody really wants to say too much right now, and but things have to get paid for somehow.
They do indeed.
Yeah.
They do indeed. Adrian, you mentioned to me about protecting your mortgage. Yeah. This is something that I have actually never, in all my years, I have never heard of.
Okay.
Could you tell us a bit about that?
Yeah. So a lot of people buying a property will be taking a mortgage. They're looking at the upside. They're really excited about the new family home or the home for the couple or whatever's happening. They're excited about the property, but actually, God forbid what were to happen if, one of you passed away because we need both the incomes. What happens if you can't work due to illness or accident? What happens if you contract a critical illness or something? Not everything goes exactly how you want it to go. So therefore, as a company, we're very good at speaking to all of our clients. I feel like we've got an obligation. If we're going to be arranging a mortgage for them and putting some debt in place against the property, we've got an obligation to have a conversation with them around, well, what would you do in this worst case scenario if this happened or that happened, etc. So I think a lot of people who are taking a mortgage should definitely be thinking about how you could protect that mortgage. What happened if one of you passed away? How's a survivor going to be able to continue to pay that mortgage? You might have children. How's the survivor going to be able to service the mortgage every month and continue to pay the council tax, food, etc., and to keep going? So we have a lot of conversation with our clients to make sure that, God forbid, if one of them passed away, that the mortgage debt can be paid off, and therefore the survivor can stay in a family home.
Okay, so the product will actually pay off the remainder of the mortgage.
Yeah, it's life cover. It's sort of level term life cover if the mortgage is interest only, or it's decreasing term assurance if the mortgage is capital repayment. So
it's a form of life cover.
It is life cover.
Okay, it is life cover.
Yeah. Repaying the debt if one of you passed away is life cover, and I just think a lot of people should be thinking about that. And I think when you're looking at the overall budget, how much you can spend every month, on your mortgage, you should be allocating something for that as well. So God forbid if the worst were to happen, well, you can stay in that family home, or the survivor stays in a family home. But it's similar with your income. We've been talking about banks, how they assess affordability, etc. It all comes down to income. Most people taking a mortgage, they need that income to service the mortgage, service their lifestyle. what would happen if you can't work due to illness or accident? If you're employed, how long is your employer going to pay you for? And actually, when a lot of my clients come back with their contract, they're quite surprised that they're not necessarily going to get paid for that long if they couldn't work due to illness or accident.
Sure.
I think a lot of people just presume that they'll be looked after, or it'll be okay, or I don't really know anyone that's happened to, etc. And maybe not want to think about that, but it's definitely something you should think about. And in fact, now I'm sort of the age that I am, a lot of my friends are thinking about it more because actually they may have had another pal who's something's happened or something, but we can put something in place as long as you're fit and healthy. But it's going to cost you a bit more now you're a bit older because chances are something more likely is going to happen. Actuarial statistics.
I think with a lot of those, maybe not so much life cover, but a lot of those financial products or these insurance products, they've had a lot of bad press in the past, from some of the scandals that have been around. Is there any that you particularly recommend for people taking up? Because I know that when you take these life covers, there's a big disparity in the cost that you pay every month, whether it relates to like a sudden death scenario or an illness scenario.
It kind of depends on what you're covering for. But yeah, to your point, if it's more likely that you're going to contract a critical illness rather than maybe pass away
and slowly become more and more unwell.
Yeah, maybe not be able to continue to work, etc. So yeah, to your point around that, if you want to put a policy in place that's going to pay out a lump sum if you get a critical illness, it's going to be a lot more expensive than a lump sum paying out if you were to pass away. Because the chances are greater that you'll have a critical illness. You may have a critical illness and be absolutely fine. Be able to carry on working, etc. It pays out. But the life cover, which purely pays out, God forbid, if you were to pass away, that's a lot cheaper than the lump sum that might get paid out if you were to have a critical illness. And it's all based on actuarial statistics. Your age will have a big influence in terms of how much you're paying for this, because if you're 30, you'll be paying significantly less than if you're 40 or 45, because it's less likely something's going to happen. Your occupation as well. If you're working in a higher risk occupation, or if you're not behind a desk all day, etc., then your premiums may cost more. The life insurance companies look into your lifestyle as well. If you're big into your free diving or big into skydiving, etc., there may be some exclusions.
Sure.
If you're motor racing at the weekend,
okay.
They do look into it properly. But with the life cover, as long as you've been honest on your application, they'll often get a doctor's report as well, etc. God forbid if it were to happen, the mortgage is paid off and the family can stay in the property.
Okay, very interesting. So, and what is next for Anderson Harris?
Well, I mean, as a company, what we're really aiming for, is to be the pound for pound best mortgage broker out there. We're not necessarily looking to be the biggest, but we want to make sure that as a business, we're delivering the very best customer experience. We want to be a business where other mortgage brokers maybe in the future might decide if they're leaving or moving, they might want to come and work here as well. We want to make sure that our clients recommend us. We're spending a lot of time on making sure that we do get Trustpilot reviews. There's so many things with the business, aren't there, that you've got to be doing all the time as well. We just had a new website. We've had a bit of a brand refresh as well.
AndersonHarris.com?
Yep, Anderson. Yep. Yeah, AndersonHarris.co.uk, actually, AndersonHarris.co.uk. But we've had a rebrand. We've got a really good website. So if anybody wants to have a look, that's looking great. And in terms of how we communicate with our clients, how we communicate with our introducers, we're spending more time now, on the social media platforms, etc., putting interesting content out, educational pieces, etc. We don't just want to be talking to each other or our peers. We're trying to put information out there that's actually going to be useful, that will actually add value to people.
I think with so many people that the finance products are like a dark art, just because there's just so little information out there about how they actually work.
Yeah.
So I think that's super.
Yeah, and I think people get quite anxious about it. They get quite concerned, it's a mortgage, but actually, we got to spend a long time holding our clients' hands to make sure that they fully understand it.
And we talked just briefly about the election, but do you have a wish list for the future of the financial sector, or from the new government or legislation? Is there anything out there that you think is still stuck in the dark ages, or that needs updating or fixing?
Politically, it's very difficult to know what we should be thinking, in terms of what's happened so far. But in terms of just the banks and how they behave, just a couple of things. Like the interest rates keep on changing. Not interest rates, but the swap rates keep on changing. So the banks normally price their mortgage funding based on the swap rates in terms of what's happening in the markets. Mm-hmm. And something I've noticed over the last sort of 9 months or so is when the swap rates tend to increase, cost of funding increase for the lenders, banks are quite quick to increase their mortgage products, like very, very quickly. Mm-hmm. But when the swap rates come down,
of course, yeah.
they're not quite so quick to reduce that
it's for like the consumer. Gas supply prices.
Yes, and I'm just thinking, can these rates come down a bit? Because the swaps have come down.
Yeah.
And just in terms of climate change and people's outgoings, etc., it would be great if the banks could come out with some sort of product or something which could help people actually change their property. Like there are green mortgages out there. So there are some banks who, if you're lucky enough to live in a property with like an A credit or B sort of EPC, etc., then mm-hmm. maybe you'll get a couple of basis points off your mortgage, which is quite insignificant. But actually, it would be nice if the banks maybe had some kind of product or an extra amount they might lend people, where there needs to be governance out there for this, but proper governance to make sure it happens. But maybe the bank could say, okay, an extra £5,000 you can have, that needs to be used on insulating the property or putting a new boiler, heat pump, or just making the properties more energy efficient. And when that mortgage gets paid off, or when you sell the property, obviously you've got to pay that money back. But that money can be used for people to make the houses better from an environmental perspective, save that person some money in the meantime, and maybe on that small amount that they're not charging interest.
That's a lovely
idea.
That'd
be nice.
Adrian, let's I hope they do that. Use your platform for
just
change.
a thought. Okay.
Adrian, thank you very much.
Thank you for having me.
Very interesting.
Thank you very much.
Cheers.
Thank you.
This show is brought to you in partnership with the Better Home Company. The Better Home Company provides exceptional construction and aftercare for luxury projects across the UK and EU.